What's up, everybody? Welcome to the Stocks channel. My name is Corey, and in tonight's episode, I'm doing another stock market technical analysis update. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along with all of my updates. Now, first up, we have the ticker symbol SPY, which is the S&P 500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. All right, so today was very interesting to say the least, and we saw today's price action actually gap down below our gap. So we had this gap here at $327, and the price action closed below our gap. So if we zoom out a little bit, we can actually see where the gap was formed back at the end of July, all the way over to the gap down this morning, actually left all of this price action on an island reversal pattern. Now you can see here in the last hour of the close, we did push into this gap and get about halfway up before the price ultimately closed in the gap. So remember, this gap was supposed to act as support for the bulls on the way down, but the bears were a little more clever than the bulls, and they actually took the gap out of play by opening the market right below the gap. Now there's no coincidence that the bears were targeting this level, because now they can use this gap as a level of resistance that the bulls now have to try to break through, and the bears can use this gap now as a level of defense to pull the market further down. So right now we want to acknowledge that this gap is resistance, so we actually want to move our support level up, and for the sake of clarity, we'll turn it red so we now know this level is resistance. So the bears will now have resistance at the $327 level because of the fact that they were able to gap the price below this gap, and now that we expect this gap to act as resistance, the bears have a level that they can short into in any event that the market comes up to this $327 level. So right now we're still very bearish on this market, and you can tell from this chart that ever since we double topped and broke down below the neckline, we're still expecting more downside on this market, and we still have lower highs and lower lows on this market, which is telling us that the trend is down and the bears are still fully in control. So if we jump back over to a daily chart, we see here that we are still fully in the ABC correction pattern that we have been expecting, and right now we're trying to figure out where the end of the C wave is going to be. So remember, one of the possibilities was that we found support in this gap level and then bounced off of support, but we need to ultimately see if the bears are going to drive this market into a lower high and lower low situation, which will continue this downtrend. So we see with today's price action that we did close below the 5 EMA and the 50 EMA yet again, which is very bearish price action. And we now have that 5 EMA aggressively crossing back below the 50 EMA. So now that the bears were able to drive the price action and drive this bearish trend, the bears have a lot of resistance that they can play into. And we could actually see a bounce into the 50 EMA before finding resistance. And we could even bounce as far as the 20 simple moving average and then find resistance. And we're still going to be forming those lower highs and lower lows on the market, which is going to continue that bearish trend. So right now we need to protect our capital, and we need to acknowledge the fact that September is a correction month, and we're in the last couple weeks of September before we ultimately will see the end of this correction potentially. But right now it's too soon to say if this correction is going to be the end of the bear market. And right now we still have to assume that this long-term trend is bullish. And in the grand scheme of things, this is simply just a correction to that bullish trend before we continue our bullish trend back to the upside. So we're not going to speculate right now if this is a bear market or just a correction. We're going to simply follow the price action and follow the trend. And right now we still have a bearish short-term trend, and we have to acknowledge the fact that that C wave could come all the way back down into this 1.618 Fibonacci extension, which would bring us all the way back into SPY levels of $300 yet again. Now, if we can see a significant bounce off of any of these Fibonacci extension levels or these support levels that we're into now, and we could somehow get up here and form a higher high and then test support and form a higher low, that will be the first indication that this was just a correction and that the bull market is resuming. So one scenario is we find support and form that higher high and higher low and then resume that bullish trend to the upside. However, the other scenario is that we ultimately find support and form a lower high and then come down and form a lower low. Now we know lower highs and lower lows are the absolute signature of a bear market. And right now we have to acknowledge that that is exactly the price action, and that is exactly the trend that we are seeing. So remember, on the SPY ETF, we have our price level up here at 342 to monitor that higher high to see if we can form it. And if we go back to that 1 hour chart, we do see this double topping pattern where we came up here to this $342 level, came down, found support, and bounced back up to $342, and then ultimately came back down again and broke down through support. So the rule with a double top is that we would go back down past the neckline the same amount as the double topping pattern, which if we move this line down here, we can see that brings us all the way down to SPY levels of $316. So it's showing that the bears are going to use this gap as resistance, and they're going to continue to try to drive this market down as long as they can keep the price below this support level at $330. Now, if the bulls can prove the bears wrong and come up here and attack this $330 level and close above it, that will be the first step for the bulls to try to reverse this trend. And that's not going to be an easy thing to do because there's a lot of downward selling pressure on the market right now. So if you are bullish and you're trying to find an entry, you really need to wait at a very minimum to see if the price action on the S&P 500 can at least get into the 330 range and break above it and get a solid close above that level. Now, if we can close above 330 and then come down and test it as support and then bounce again, that would be further indications that the bulls are heading in the right direction, because we will have a short-term higher high and a short-term higher low, which will be a micro scale trend reversal that could ultimately go on and reverse the daily trend that is a bearish trend currently. But right now we need to acknowledge that this did leave a island reversal, and we do have all of this price action currently sitting on an island where there is a gap above and below the price that we have not closed yet. So an island reversal is a trend reversal pattern, which would be a trend reversal from the long-term bull market that we have been in so far. So watch for this gap. It's still a critical price level that we need to acknowledge right at this $327 level, and a close above 327 would be a first indication that the bulls are going to come up and attack this $330 level as well. So going back to a daily chart, we still see that 5 EMA is trading below the 13, which tells us that the trend is still bearish. And we do have further confirmation that 20 simple moving average has reversed to the negative side, and the market is no longer neutral. We are now officially in a bear market, as that 20 simple moving average is sloping to the negative side, and we now have consistent price action below the 50 EMA for 2 days in a row. So the bears are in full control of this market. And the bears are only going to lose control of this market if some very good news floods the market, such as a stimulus deal for the economy. But right now, it doesn't look like we're any closer to such a deal, and the bears are going to remain in control as long as they can keep the price action suppressed below these moving averages. You can also see that we did have a technical bounce today because the price action did go well below the Bollinger Band. And typically speaking, when the price action gets too extended outside of the Bollinger Band, it is normal to see a retracement back into the Bollinger Band trading range. So it's too soon to say if the close at the end of the bell was a bullish reversal or if it was really just a technical bounce from being way too extended to the downside. So right now, given the price action and given the trend, I have to still give benefit of the doubt to the bears, and I would still think we're going to see price action down into the 315s or even the low 300s before we ultimately see the end of this potential correction. Also keep in mind that we've been watching volume, and we did see consistent volume increasing, and we're starting to see the volume increasing on downward price movement. So that tells us that smart money is still selling more than they're buying. And as long as we see the stock market following on this increased volume pattern, that's telling us that smart money is doing more selling than buying. And I would not expect to see this reversal in this trend until ultimately that smart money sees a buying opportunity. And really, I don't think that smart money is dying to get back into the stock market right now. I think that smart money is trying to sell right now, and they're not even thinking about getting back into their positions until a much later date. And it could be after the election. We don't know how long this sell-off's going to last. But general rule of thumb is assume this sell-off is going to at least last into the end of the month here. Next up, let's take a look at the NASDAQ 100, and we're looking at the QQQ ETF or the triple Qs. And we do see that the NASDAQ actually closed up about 0.25% after being down quite considerably throughout the intraday trading. So the price action went as low as $260, but we ultimately closed all the way back up around $267. However, that is still very bearish price action on the NASDAQ 100 because we can see here that we still are closing below the 50 EMA and the 5 EMA. That 5 EMA has now officially crossed under the 50 EMA, which tells us that this bearish trend is picking up momentum and the price action is not able to stabilize to the upside, and the downward trend is gaining traction. The longer this downward bearish trend remains, the more power and the more momentum those bears are going to have, and the more resistance levels they'll have above to short into. So in any event that we do see a bounce up to the 50 EMA, I would expect to see the bears begin to short this market again and try to drive these prices lower, because as long as the bears are in control, they're going to continue to short at those resistance levels. The equivalent to that would be in a bull market, the bulls buying at support levels. So it's no different. Just imagine you turn the graph upside down, and now instead of buying at support levels, you're shorting at resistance levels. So we can also see on the NASDAQ 100 that 20 simple moving average has gone negative, and we saw the market sort of go neutral as that 20 simple moving average went flat. And now we see the 20 simple moving average starting to slope down to the negative side. We also see the 5 EMA and the 13 EMA getting more negative, sloping downward, and we're starting to see them cross below the 50 EMA, which is more bad news for the bulls and more good news for the bears. So we also see a technical bounce on the NASDAQ 100. We came all the way down to the bottom of the Bollinger Band before ultimately finding some buyers that drove the market higher into the close. So right now we still have support levels at 256, and we do still have our Fibonacci retracement level support at $250 on the NASDAQ 100. So it's still possible we're going to finish out this ABC to the further downside before we ultimately find support, and then we'll see if we can come up here and try to form that higher high and that higher low before ultimately becoming bullish on the NASDAQ 100. Next up is the Dow Jones Industrial, and we're looking at the DIA ETF, and we see that the Dow Jones had an absolute terrible day today, gapping down well below the 50 EMA and actually closing one of our price gaps, which we can now delete. So we still have one more price gap down here on the Dow Jones DIA ETF down at $264. And again, the Dow Jones also had a technical bounce today because we saw the price action come all the way down to 267, which was well extended below the Bollinger Band. And even though we bounce off that level, we still closed below the Bollinger Band. So we also see increased volume on a huge down day, with the Dow being down negative 1.84%, which tells us there is a lot of people running for the exit and selling out of the stock market right now because we see lower price action on increased volume. Now remember, the Dow Jones was looking the strongest of the three sectors last week, but obviously everything is subject to change in the stock market, and we are seeing the Dow Jones finishing out this C wave down, which I would not be surprised to see the C wave come down to the 264 before finding support. And then ultimately we could see a bounce on the Dow Jones at that level. A bounce doesn't mean we're out of the water yet, because as long as these trends are forming lower highs and lower lows, we have to remain bearish because the trend is telling us that this trend is down. And remember, the trend is our friend. We're not going to fight the trend, and we're not going to try to call a bottom. We're going to simply wait for the price action and for the trend to tell us that this bear market has reversed. And right now we're going to protect our capital, and we're going to continue to monitor the stock market on a day-to-day basis. So look out for the downtrend. We see that the Dow Jones has a very negative sloping 5 EMA. It looks like everybody's running for the door and selling all of their stocks, which you'd never want to be trying to catch a falling knife in these situations. Wait for that bounce, wait for that support level, and let's ultimately wait for a trend reversal before we become too bullish on this market. Next up is the VIX, which is our fear indicator, and we do see that the VIX finally got through that inflection point where it was trading around the 20 simple moving average, and it looked like that bullish trend was reversing to a bearish trend. However, with today's price action, we see that's not yet the case, and we see the price closing back above all the moving averages, and the moving averages starting to remain overcrossed into the bull camp. So as long as the VIX is in a bullish trend, that means fear is in this market, and the higher the VIX goes, the more volatility we expect to see in the market. So remember, if the VIX can get back into the 30s, we're expecting to see very volatile 4 to 5% swings in the stock market again. And typically speaking, as the VIX rises, the stock market falls. So right now, the VIX is aligned with the stock market going down today, with the S&P being down over 1% and the VIX being up 7%. That is a positive correlation, and that is exactly what we would expect to see. So right now, we need to continue to monitor the VIX, and we need to check to see if the VIX has found support, and now it's resuming a bullish trend back into the 30s, because that's going to tell us a lot of information about the remainder of the year in the stock market. There's a lot of uncertainty, and there's a lot of volatility coming into the stock market going into this United States election coming up. And right now, we need to follow the trends, and we need to be very cognizant of exactly what the VIX indicator is telling us. And it's telling us that there's fear in the market and that we need to protect our capital right now. So let's take a look at the sectors driving the stock market. And first up is financials. And there is a lot of bad news in the financial sector today. Remember, I've been saying that this trend needs to show that it's bullish and form that higher high. However, we saw the exact opposite form in the financials today, and we did actually form a lower low. So we do have a confirmed bearish setup in the financial sector, which is bad news for the S&P 500, because we don't expect to see the S&P 500 go to new all-time highs while the financial sector is in a bear market. So how do we know that the financial sector is potentially in a bear market? Well, we do have the 5 EMA in a bearish setup, trading below the 13, crossing back below the 50, the price action closing well below the 50 EMA, and we have formed a lower low. So we did break out of this consolidation wedge pattern to the bear side because we did break down below the support trend line, and we did fail to break back above the resistance trend line, and now we have formed a lower low on the market. So if you look at these peaks and valleys, you can see that we have lower highs and now we have lower lows, which means that the trend is picking up downward in the bearish direction. And if the financials are picking up into a bear market, it's only a matter of time before the rest of the stock market follows suit. And it's hard to believe that the financials could be into a bear market while the rest of the stock market is making new all-time highs. So right now, the financial sector is telling us that there's a lot to be worried about. And if we continue to see downward pressure on the financial sector, that's going to make us very bearish on the remainder of the stock market. Next up, let's take a look at the industrial sector. And on the industrial sector, we do see quite a double top pattern forming here, where we came up into this range, came back down, found support, bounced back, and then got rejected and broke below the neckline. So remember, on a double top, you have to break down below support, and we do see with today's close that we did double top and we did break down below support. So with that being said, I would expect to see a 4% drop from these highs and this support level, which would bring the industrial sector all the way down to about a $73 level, which is still considerable more downside before we hit this bottom. And then ultimately we'll see if we find support at that level or not. Remember, we still do have a gap here on the industrials down at 72, so it wouldn't be shocking to see this gap get filled before we find support and potentially resume that bullish trend. But right now, we're not making any predictions on where the bottom is, and right now we see a lot of bearishness in the stock market, and we don't know where that bottom's going to be, but we do know that there's potential more downside coming, and we need to be cognizant that the downside could be limited or the downside could be just starting. Next up is the healthcare sector, and we see a very similar story forming that lower low. However, we still are in a very ABC correction pattern that we have to acknowledge could reverse when the correction's complete back into a bull market. But right now, I'm giving benefit of the doubt to the bears because they are 100% in control of this market right now, and they are successfully driving the stock market lower. So on the healthcare sector, we see the price action closing well below the 50 EMA and a continuation of that bearish trend while that 5 EMA still remains below that 13 EMA. Next up is the US dollar, and remember, the US dollar showing strength is going to show us that the stock market needs to go through a correction. And the US dollar was at this inflection point where it was trading right around the 20 simple moving average, and it was holding on to its bullish trend with that 5 EMA barely staying above the 13 EMA. Now remember, the longer something consolidates, the more energy it builds up, and we see that energy stored up in the dollar exploding to the upside today. And we did form a new high, but by a very small margin. So we have this previous high right around 93.53 in today's close, just a little bit higher, about 10 cents. So it's too soon to say if the dollar is going into a bull market, but it is looking good. And if the US dollar can come out and form a new higher high, we already do have a higher low. And that will tell us that the dollar is going into that bull market, which is going to tell us that we're going to expect a further correction in the stock market. Remember, when the dollar was showing all of this weakness and it was tanking, the stock market was doing the exact opposite and the stock market was screaming up. Well, now that the dollar is strengthening and we're seeing the dollar show some signs of strength, we're seeing the stock market actually going down. And that's completely normal because the dollar was leading to asset prices inflating. And now that the dollar is strengthening, we're seeing those asset prices correct a little bit and come back down to normal valuations. So right now, everything's looking bullish on the dollar, and we are seeing that higher high beginning to form, and we do already have that higher low, and we still see the 5 EMA above the 13, which is still showing us that the trend is bullish. Next up is gold, and we see gold holding up to a very important support line, and it did break down below our 1920s level. But if we go back to this low where we did find support and we had this long wick, which was somewhat of a stop loss hunting fake out, we do see that we're holding up right on this level of 1912. Now remember, with stop losses, everybody's going to be different, but one thing you could do with stop losses is set it to a closing price, because there will be these stop loss hunting wicks that come down past these support levels, trying to get people to stop out of their positions. Now, if you go off of a closing price, you see that you would not have got stopped out around these support levels because that wick did not actually have a closing price. Your stop loss would not actually trigger until the end of the day. But right now, it's too soon to say if gold's going to find support. With the dollar strengthening, it's hard to believe that gold's going into a bull market. But if the dollar isn't actually going into a bull market, we could see support found at this level and gold ultimately bounce. But it's not looking good for gold and silver. And with the dollar showing strength, I would not necessarily be a buyer of gold at these levels until we see further indication of what the US dollar is going to do. Next up, let's take a look at Apple, which is one of our market moving stocks. And we see Apple actually open much lower than its closing price, and we did come all the way back up and close right on the 50 EMA. However, we have to acknowledge that the price action is still bearish on Apple because we're closing below the 5 EMA as well as the 50 EMA, and the trend is still very bearish with that 5 EMA trading well below the 13 EMA. And that 20 simple moving average is getting very negative and rolling over to the downside. We also know that Apple still has this gap down here, and that will close the gap at $96. So I'm still fully expecting Apple's ABC correction to come down into the $96 range before finding support and seeing if Apple is going to go back into a bull market. So right now, Apple is that market moving stock, and with its bounce today, that did help bring tech into a green close. But Apple's still in a very bearish trend, and one bounce off a bad day like today is not going to be a trend reversal. We're still in a very bearish trend, and the price action is still very bearish on Apple. Next up, let's take a look at Tesla, and we see another very volatile day on Tesla with the wick coming all the way down below the 13 EMA before ultimately closing back up about 1.64%. Now with Tesla, we did go back into a bullish trend with that 5 EMA going back above the 13, and we did find support and bounce off the 20 simple moving average. So it still looks like Tesla's coming back up for this $500 range and testing it again. And ultimately, when we get there, we will see if Tesla is going to double top and head back down, or if we could potentially break out and form a new higher high and continue this crazy bull market that we've seen in Tesla. A quick update on Bitcoin is we are seeing somewhat of a correction in Bitcoin as well, potentially due to the strength in the dollar, but we did still hold up on the support level at $10,200. So this support level here is holding up nicely. And we do see Bitcoin at another inflection area where we're going to see if it's going to continue around its 20 simple moving average and find support and continue its upward bull trend. Right now, I'll have to give benefit of the doubt to the bull trend on Bitcoin because it did find very strong support. And we do see with evidence of this wick that there is still support at this level. So right now, it still looks like the bulls are in control of Bitcoin, and I would look for Bitcoin to come back up and test this $12,000 level. So to wrap this up on SPY, we're at a very critical junction with the bears battling the bulls, but right now the bears are still winning, and they've turned one of the bulls' strongest support levels into a resistance level by just gapping down below it overnight. So right now the bears are in control, and I would look for the price action to come back into this gap to close it from the bottom and potentially find resistance at 327 before resuming a downward trend. Now to the downward trend, we still have support levels at the 1x Fibonacci extension as well as the 0.382 on the larger scale, which is going to find a support somewhere around the $305 or $315 levels. Now, any of these Fibonacci extension levels could act as support, and we'll know that because we'll see the price action come down into one of these Fibonacci levels, and we'll see a confirmation bounce off of that level. Now, once we bounce off that level, we still have to wait for a continuation pattern where we see a higher high and a higher low forming. But ultimately, we want to come out and take out this previous high before we become bullish on this market. By then, I would expect to see that 5 EMA cross back above the 13 EMA to the bull side, and we will then know that the correction is over and that we can go long on this market. But right now, the bears are in control, and right now I would not be buying aggressively until we find out where the bottom of this correction is going to be. So please remember to smash that like button on this video to help me out. I really hope these videos are helping you out. And if you want to follow along with all of my analysis updates, please remember to subscribe to my channel. Thanks for watching, everybody, and as always, I will see you in the next episode.